Hello, everyone. Welcome to May 2nd, 2018. It's Carly Rosenfeld and Maureen Giggy from the benefits team. We also like to welcome Kendall Storch from Arthur J. Gallagher, our 401k advisor. So today we're going to go over the 401k market plan update. And just so everybody knows, this will be recorded. And for questions, please feel free to type your questions into the questions box on your GoToMeeting, and we will get to them at the end. And again, this will be recorded, so you always have a recording at the end, probably in a couple of days once it's processed. So feel free to ask questions as we go along, and with that, I'll welcome Kendall.
Great, thanks, Carly. I appreciate it. Good afternoon, everybody. Thanks for taking some time today. We'll spend perhaps about an hour together covering a variety of different topics. While I'm on that, I might as well move to our agenda slide here so people can see what we're going to talk about today. Let's see. There we go. Fantastic. So basically, three different things on the agenda. We'll walk through a review of the markets through Q1 of 2018. We'll take a look at the fund performance within the 3DS plan. And then I typically do some sort of a spotlight of some sort. I choose a topic and try and discuss that in a little bit more detail. So today we're going to talk a little bit more about the target date funds. They're a popular investment choice within the 3DS plan, so we figured we'd spend a little bit of time getting to know the target dates in a little bit more detail. And then finally, we'll open it up for some questions, and I'll do my best to try and answer them as we go along. So that's effectively what we're going to talk about today. So without further ado, we'll jump into our market overview. High level, a couple of things for us to contemplate as we look at the markets here in 2018. I think the number one item that people will notice from 2018 is that it has been a much more volatile market than we had in 2017. And I'll talk a little bit about how little volatility we had last year compared to kind of how much volatility we've had so far this year. So a couple of the themes that are out there that we're following, certainly the globe as a whole from an economic standpoint continues to do well. You may have heard this term, synchronized global expansion. That term is still very much at play as we sit here today, where we have the US economy growing, but we also have that happening at the same time that European economy is growing, that Japanese economy is growing, and that the emerging markets are growing. So it's a little unusual to have kind of all the major economies and minor economies, for that matter, basically moving in the same direction. So that creates a great backdrop for stocks. And we saw that very much at play in 2017, where we had a great year for equities with the S&P 500 index up nearly 22% last year. So last year was one of those years where, you really made hay, so to speak, while the sun was shining. It was one of those more kind of banner years as you look back on the returns that your portfolio might generate. As we look at some of the other components that are happening. So I talked about the global expansion, but also the firming inflation. So that's another theme that we're definitely following, is an upward trend in inflation. We really haven't had much inflation to speak of, easily going back to 2008, and then even before that, inflation really hasn't been that much of a factor for quite some time here in the U.S. But we are starting to see that come back into the conversation, and certainly something that the financial markets are watching pretty closely, because that will have very much an impact on how markets move forward, depending on kind of where inflation goes. We'll talk a little bit more about that as we move along. We have some outlook slides here, or bullets here, but I think I'll cover those towards the end of the presentation. Okay, so let's take a look at some returns. We have returns here through Q1. as well as on a 1-year basis. So the big winner for first quarter of 2018 was actually gold. So gold was up 2.5%. So that's an interesting indication, I guess you could say, or it's an interesting proxy for kind of what the market was feeling first quarter. So typically gold is a very defensive investment. Usually people are headed there if they're uncomfortable with kind of where the markets are headed, or for that matter, if they're worried about inflation. If they think that inflation is going to rise, people will tend to move towards gold because gold tends to hold its value. So it's an interesting indicator that we see gold as being the top performer for first quarter. As we kind of scroll down the list, another thing that's we haven't seen in quite some time is the negative numbers. Look at how many of the different asset classes ended up in the red for first quarter. It was overwhelmingly most of them. So really the only 3 that ended out of the red was small stocks outside of the United States, so international small cap, emerging markets, and then gold. So very hard, quite frankly, to find positive returns for first quarter. So, why did that happen? What were some of the backdrop items out there that were causing this? So there were, I would say, kind of 3 major issues that popped up first quarter that caused the markets to become much more volatile. So number 1 was the passing of the Trump tax cut, basically. So the Trump tax cut was very business friendly, so to speak. Redefined kind of what the tax rates were going to look like for U.S. corporations. The feeling because of that tax cut is that's going to provide a lot more or a big boost to corporations' earnings for not only this year, but maybe kind of pushing forward into the next couple of years, as they won't pay as much in taxes. So that would be viewed as sort of a boost for the economy. So that's why January of this year, the market continued to head north. So it was continued its trend from 2017. As we got towards the end of January, the market began to focus much more on sort of this inflation discussion. So we've seen interest rates beginning to creep up. We'll look at some information around that and some of the other slides. We've had the federal government raise interest rates 6 times since 2016. So we have a Fed that is looking to raise rates, but we're also beginning to see inflation in some other areas, whether that's oil or whether that's actually with wages. So concern over inflation was definitely one of the factors that influenced the market beginning to pull back and add volatility to kind of our smooth sailing from 2017. So couple the inflation story with tougher talk around trade and the I guess you could say impending steel and aluminum tariffs that the government put into place. So concern over trade war between the U.S. and China, or potentially even the U.S. And European countries, also stoked the flames around which way the markets were headed. So we had some, as is I guess typical, we had some good news, namely the tax cut, and we had that sort of counteracted with I guess you could say some either bad news or some unclear news. And really for the markets, anything that is unclear is going to be viewed as kind of negative news.
Hey, Kendall.
Yes.
It's Carly.
Sure.
We got some feedback that the right side of the screen is cut off a little bit. I'm not sure if you can zoom out a little bit on your PowerPoint but we just got some feedback and are not sure if that's our end or yours.
Let's see. I'm going to pull this up and we'll see. I wonder, hopefully it's fixing itself.
That's actually too zoomed in. So I'm not, the one before that actually was better. So
right. Yeah,
no stress about it. I just wanted to see maybe if we can alternate it a little bit. Maybe
How
even
does
just
that?
having this be easier.
Okay. What I can do is I'll shrink down my little slides over here on the side so nobody gets too much of a preview. Does that look okay?
Yeah, I think that's better than what we saw before. It was just cutting off some of the years on the right-hand side of the graph, and that's fine.
Okay. Sounds good. Well,
Thank
we'll
you.
go with this, and hopefully this will work.
Thank
So looking at some of the U.S. sectors, so this is another thing that we like to kind of take a look at is, what components of the economy did well last quarter and what components of the economy did not necessarily do well. So similar theme here, basically outside of tech and consumer discretionary, every other major S&P 500 index sector was in negative territory. And pretty wide range. You go from a negative 1% return for financials to a 7.5% loss for telecom. So the range in returns here, I think, draw back to again that kind of inflation story. So some of the businesses that are going to be more impacted by higher interest rates, telecom, consumer staples, energy. Those are typically businesses that are going to be more sensitive to interest rate movements because they require a lot of capital. So if you're putting up telephone lines, you're digging holes in the ground to put fiber optic cable, that requires a fair amount of capital to operate. If you're drilling oil or putting oil rigs in the ocean, or you're drilling for oil, or shale or something like that here in the US, also capital intensive. So any of these sort of businesses that require a lot of capital are going to be very sensitive to interest rates. The industries further up towards the top of the list, a little less sensitive to interest rate movements. Financials actually tended to be a little bit more of a tax-heavy business, so the tax cut was particularly beneficial for financials, so they didn't fall nearly as much. But as you're looking at the funds that you might be invested in, this might give you some indicators, so to speak, of what the performance of those funds is all about. If you have funds that are heavy to energy, heavy to real estate, chances are the returns on that fund probably weren't so great. If you have funds that leaned more towards the sectors towards the top of the list, you probably have much better results. Go here. So I wanted to make a couple comments again about volatility. So I have a little a stat about last year that I thought was pretty interesting. So last year, if we look at the S&P 500 index and the number of times that the index was up or down 2 percentage points in a single day, the number of times that occurred last year was 0. So we didn't have any days in 2017 where the S&P 500 index was up more or down more than up more than 2% or lost more than 2%. So far this year, we've had 6 days where the S&P 500 index was plus or minus 2 percentage points. Scaling it back a little bit, let's say we just looked at 1 percentage point movements. Last year, we had 8 days where the S&P was either up or down 1 percentage point. So far this year, we've had 23 days where the S&P 500 index has been plus or minus 1%. So I thought that was a pretty interesting stat around kind of how much volatility has moved back into the market. This slide is essentially kind of coming at the same point where you can see the range of kind of volatility movements over the past 5 years. Basically, the blue line is indicating kind of where we were at the end of March in terms of sort of what percentile of volatility we had. So we were in our 90th percentile of volatility, so a lot of volatility for US equity markets at the end of March. Relative to the little, I'll call it orange triangle, look at the amount of volatility or the percentile of volatility US equity markets had last year. So big wide disparity between the blue line and the orange triangle for US equities. All the others, amount of volatility much less, certainly, than kind of what we've been seeing here. But this, I think, is becoming much more commonplace as the year goes on. It's becoming more and more typical for us to have a day where the Dow Jones, for example, might be up 300, 400 points, followed by a day where the Dow Jones is down 300 or 400 points, and then the cycle kind of continues. So I think this will be something that we'll continue to see as the year goes on, is that volatility component is going to be much more part of the discussion, and will be something that people will be talking about 3 months from now, 6 months from now, 9 months from now. So I wanted to make a quick comment here on earnings. So it's interesting, back to the volatility discussion, that the volatility that's occurring really doesn't have much to do with corporate earnings. So corporate earnings, we're kind of in the middle of earnings season right now, as companies are disclosing, what their results were like for first quarter. Once again, the S&P 500 is on track to have 20% earnings growth for 2018. That's the expectation, and first quarter was in line with that. So 20% earnings growth is very strong. We only had 11% earnings growth in 2017. So that big push, and you kind of see it with the chart here on the left, a lot of that is due to the tax cut and expectations about what that tax cut is going to do to corporate earnings. So usually when we look at the stock market and we talk about what's driving the market, it's all about earnings. Earnings is usually the biggest driver to where the market goes. So companies' health, corporate earnings right now still looks very strong. So it's not the corporate earnings piece of the equation that is causing the volatility. It's the uncertainty around where inflation is headed and the uncertainty around what's going to happen with trade that is causing the market to kind of being up and down, or kind of pinball back and forth as we go day to day. I thought the right side of this slide is also kind of interesting. So, if companies do get money back as a result of the tax cut, how are they going to spend that money? So the majority of it, I would say, would be more investor-friendly actions, so either dividends, share class buybacks, paying down any sort of debt. That accounts for roughly 60% of what corporations are saying they intend to do with the money. About 30% would go to wages, or perhaps hiring. We have 30% would be wages, hiring, or capital expenditures. That's buying new computers, or renovating the office space, or whatever it might be. The 30% that is CapEx and wages, that's important for the economy as a whole. The other ones are good for the price of a stock, but wages and CapEx spending is good for the economy. That's what's going to put money in people's pockets, and they'll go out and they'll spend that money either on a new car or on groceries or whatever it might be. And that ultimately is kind of what causes the economy to continue to do better. So still about a third, ideally, perhaps maybe a little bit more would be allocated that way, but that seems to be what survey data is telling us about what companies plan to do with the tax cut. All right, next slide. So, back to this inflation discussion. The output of inflation is ultimately higher interest rates. So we are starting to see that without a doubt, with interest rates moving up. I had mentioned that the Fed has raised interest rates 6 times since the end of 2016. So that factor, coupled with increasing oil prices and wage pressures, are causing the yield curve to move out. So if you look on the right side of this chart, basically what it's showing us is kind of where were different interest rates for different maturities back in March of 2017 versus where are interest rates for different types of maturities as of 2018. So you can see for a T-bill or 3-month note, interest rates have gone up pretty significantly. So being, let's call it maybe 70.75% at the end of March 2017 were, 1.7, 1.75% as we sit here today in 2018. So, ultimately rising interest rates funnel into the economy as a whole. So if you're borrowing money from a bank or something like that, if you're looking for a mortgage, all of those types of lending, the cost of borrowing capital is going to go up. So that would be a negative for the economy. I guess the one other thing that I'll mention here is, we watch that yield curve, and we're not quite there yet, but you'll note that the slope of the curve is flattening. So you have a flattening yield curve. There are periods of time where the yield curve will invert, so you have kind of a U shape with it. That would be a period where very short-term interest rates actually pay more than slightly longer-term interest rates. That's a negative sign. So typically when you see an inverted yield curve, that's a recessionary sign. So we're not there yet by any means, but the trend of the curve is a flattening trend, so it's something that we want to kind of keep an eye on. Okay, so I wanted to make one other quick point here around kind of the economy as a whole and where is the United States right now in the growth cycle. So you can see with this chart, we're plotting a variety of different countries and kind of where they are in the economic cycle. Our feeling basically is that the United States is sort of mid cycle trending towards late in the economic cycle. So there are some countries, particularly some of the European countries that are kind of behind us, Germany, France, Italy, Spain, Japan, for example. We have some countries that are sort of ahead of us in the economic cycle. That might be China, that might be the UK. You can kind of see where South Africa is right now. They're basically in recession as it stands. So, the point of this slide is we are by no means headed towards recession per se, but I guess you could say the economic expansion that we've had, which is we're now 9 years in, it's getting a little bit longer in the tooth. By the same token, from an investment perspective, there are some other countries where they are earlier on in the economic expansion. So as you look at international investments or emerging market investments, some of those countries may have more room to run than kind of where we are here in the US. Okay. So, what have we seen for investments? Either in the mid-cycle or late in the economic cycle. So what this slide is giving us some indication around is, what types of investments have historically done well and which ones have done poorly. So mid-cycle, tend to favor the riskier asset classes, namely stocks. Those stocks have tended to do pretty well now where we are right now in the economic cycle. But as time moves on, you can see that the emphasis begins to move towards more conservative investments, or tends to move towards investments that tend to fight inflation more so. So that's why late in the cycle, we'll see commodities be a popular investment. We'll see, again, sort of relative speaking, bonds become a little bit more popular as stocks become less popular. So this might be something for people to contemplate as we look forward and how we're placing our chips in our portfolio. This was, again, kind of similar to the theme that I talked about last fall with the idea of kind of de-risking your portfolio or thinking about, how would a more recessionary period influence things. These would be some of the different types of investments that you might look at as a way to protect yourself. Okay. So, where do we stand from an outlook perspective? So again, we feel the U.S. is somewhere between the mid and late cycle phases. The global economy still seems to be chugging along at a quick pace. As I mentioned before, corporate earnings, U.S. corporate earnings were really strong first quarter. Other country earnings have also done well. So it's not so much a function of earnings per se right now. We have other factors that are kind of coming into the picture that are causing that volatility. As I mentioned, some worry about inflation, as well as some worry about trade talk, and whether these sort of tariffs will be something, an ongoing thing, or whether the tariffs may be a shorter term discussion. So the risks ultimately that are out there, like I said, trade policy, the geopolitical risk is always out there. There's not too much that we can do about that. Sort of how China reacts to some of the trade talk, that is also something that we're keeping an eye on. I have a feeling like I'm just gonna, yeah, all right. I thought I might have missed a slide. All right, I'm just gonna quickly touch on this one here, but back to that inflation discussion, I wanted to point out a little bit about kind of where oil is. I don't know if people have paid attention when they went to the gas tank, but you're probably paying more for oil than you did, or more for gas than you did a year or so ago. So just to give you some perspective on that, on January 1st of 2016, oil was $30.98 a barrel. At the end of March, oil was $66.31 a barrel. So oil has more than doubled in price in roughly, let's call it, about a year and a quarter. So, when we're talking about inflation, if oil has more than doubled, that is going to factor into the calculus, so to speak. So I had talked again about, oil could be a factor, the Fed raising rates could be a factor, a couple of other things could perhaps affect inflation as well. So we want to keep an eye on the inflation picture, because that definitely does tend to roil markets. All right, I'm going to leave it at that in terms of some economic commentary here, and we'll take a look at how the 3DS plan has been doing, and some performance figures. These are through first quarter of 2018. So I have all the different funds that we offer within the Dassault plan listed here. I have the returns for the first 3 months of the year, as well as what was the average return for the same type fund within Morningstar's database. That's the category return. So basically anything in green would be a fund that is outperforming its peers. Anything in red would be a fund that is underperforming its peers. So I think what you'll note is we still do have quite a bit of green. The overwhelming majority of funds that we have are doing better than average. Mind you, this is just a 3-month snapshot, so it's a pretty short period of time that we're looking at. But if we wanted to expand out a little bit further and see what the return pictures looks like over 1 year, 3 year, and 5 years, I have the percentile rankings for each of the different funds listed here. The way you read this chart is actually small numbers are good. So if I'll take the very first one, the American Beacon Large Cap Value, on a 1 year basis through the end of March was in the top 42nd percentile, so was beating 58% of all the other large cap value funds, again in Morningstar's database. So again, I think you'll find the overwhelming majority of funds tend to be top half, so doing better than average. As you scroll out to the 5 year mark, the number of funds top half also continues to increase from there. So if I wanted to kind of summarize what I see here from a performance standpoint, so year to date, 72% of the funds that we have are in the top half of their peer group. On a 1 year basis, 86% of the funds are in the top half. 83% on a 3-year, and 93% of the funds that we have are in the top half of their peer group over 5 years. So as you assess sort of the lineup of funds that we have, and we look at longer term periods, which are going to be pretty meaningful, by and large, the overwhelming majority are doing particularly well. They're doing well above average. Our target dates, all of the target dates that we have are in the top half of their peer group over a 1, 3, and 5-year periods. All of our funds from an expense standpoint rank below average, and more than half of the funds are on the bottom, in the cheapest 1/3 relative to their peers. So more than half the funds are not only below average, but well below average in terms of cost. So I think you may agree with me that by and large, from a performance standpoint in particular, the plan's doing particularly well. Okay. So I'm going to shift gears here for the next, I'll call it maybe 15 minutes. I'm going to walk everybody through some information regarding the target date funds that we have as part of the plan, the T. Rowe Price retirement funds. So I wanted to make sure that people were clear on kind of who is a good candidate for these types of funds, how do they operate, what are some of the considerations associated with using a target date fund. That's what the next segment of the presentation is going to cover. So nationally, there's no doubt that target date funds are very popular. From the Investment Company Institute, there was more than $1.1 trillion at the end of 2017 that was sitting in target date funds nationally. Cash flows, just for 2017, there was more than $67 billion that flowed into target date funds in 2017 alone. If we look at Dassault itself, and we look at our plan, we have more than 1,100 people who use the target date options exclusively. So they have 100% of their money sitting in an age-based fund, a target date fund. Those 111 people plus anybody else who might be using one of them represents just under 25% of all the assets in the plan. So these are popular, and it's important that we kind of keep an eye on them and make sure that people understand them. We have a lot of people using them, and they represent a fair amount of money. My last bullet here around the target dates, when we look at new cash flows, 6 of the top 10 funds for new deposits are target date funds. So giving people a little backdrop on kind of why would we spend time talking about this. It's a meaningful asset class. Okay, so what is a target date fund? Quite simply, cut to the chase, the target date funds are basically autopilot. We have a series of different target date options. I think there's 11 of them in the Dassault plan, each with a date embedded in the title. They might say 2015, 2020, 2025, etc. Those numbers represent the year in which you plan to use the money. So I'll use myself as an example. I'm 48 years old. I plan to retire when I'm 65. I will be 65 years old in the year 2035. So I would find the T. Rowe Price 2035 fund, and I could select that, and I'd basically be done. T. Rowe Price would take over much of the investment work. They would determine what types of funds will be used to build my portfolio. They'll determine what percentages need to go into each of those funds. And then as time goes on, as we get closer and closer to the year 2035, they will adjust the mix. They will change the look and feel of the portfolio as my time horizon shrinks down. Because of sort of the simplicity associated with the target date strategies, that explains why we've got more than $1 trillion sitting there nationally, and why they take in a lot of dollars. They're easy to use. So, what are the advantages of the target dates? So the way that I kind of like to try and paint the picture is, there are two different types of investors out there. There are some people who investing is very much a hobby of theirs. They like to, read the Wall Street Journal. They watch CNBC at night. They are looking at their account on Fidelity's website on a regular basis. For that type of person, perhaps they've accumulated enough investment acumen where they're comfortable kind of building their own portfolio. So for that type of person, perhaps they'd want to deviate away from the target dates. They want to kind of build it themselves. And that's fine. They probably have the tools and the skills to be able to do that. There is, however, another population of people who they are not reading the Wall Street Journal every day, and they're not watching CNBC, and they're busy with other things, and they don't have a lot of time to devote to keeping an eye on their retirement account. So for that type of person, the target date strategies can be a big help in that they make life easier for them. Like I said, if you are going to build your own portfolio, there is some work that goes along with that. You have to, again, decide what funds you're going to use, how much money you're going to put into each of those funds, and then figure out when is it time to kind of take your foot off the accelerator. So all that is kind of baked into the design of the target dates to begin with. So they will do all of that work for you. The target dates have evolved. Where did they come from? For many, many years, the industry had risk-based models. So this might sound familiar to some of the people who have had retirement accounts for some time, but there would be maybe a conservative model, a moderate model, an aggressive model. And these were, again, a mixture of different funds that were packaged together that had specific risk characteristics. But the problem with the risk-based models is that it was up to the investor to decide when their risk profile changed. So if you were an aggressive investor when you were 25 and you never went back and shifted to a different fund or a different portfolio, you would still be in the aggressive portfolio when you're 65 years old. So the big idea, or the big shift, I guess we could say, as we move towards target date funds, is that the risk component was managed. As you got older and as time went on, the target date funds would automatically account for risk. All right, a little bit about T. Rowe Price. So who is behind the target date strategies that we're using? T. Rowe Price is behind them. They are the money manager. T. Rowe's been around since 1937. They're based in Baltimore. Very popular fund family out there. They're the third largest target date manager out there. They have more than $250 billion under their target date strategies. I make the point that that's nearly a quarter of all the money that T. Rowe Price manages. So from a business standpoint, the target dates are very important to T. Rowe as an organization. They want to try to make sure that they get it right with the target dates they have, because it's a big piece of the money that they manage. Like I said before, and I kind of gave you this example, there are a variety of different, what we call vintages. The vintages are the ones, this would be the date that you would pick. So I gave my example before. Jane actually, ironically, is the same age as myself. Big surprise. Sometimes people will try to figure out, how do I choose the appropriate target date? This is kind of the strategy you would use. When are you going to be age 65? What fund is closest in date to that year? And that would ultimately be the one that you would pick. Actually, I'll go back to the vintages. So the typical way that people tend to use the targeted dates is they pick the one that aligns with when they're going to be age 65. So in my example here, 2035. In looking at some of the statistics around the DISO plan, we do have about 100 people who have money in multiple different target dates. They might have some money in the 2025 fund, some money in the 2030 fund, some money in the 2055 fund, something like that. We usually try to counsel against that because I think what that ultimately does is it distorts the scrolling down mechanism, which I'm going to talk about in a second. So if you happen to be one of those people where you're using multiple different target dates, you might relook at that, find the one that aligns with when you're going to be age 65 or when you plan to retire, and think about that as a single strategy. Another way that sometimes people will handle it is they'll use the target date as sort of a core investment. So they'll put maybe 75% of their money into a target date, but then they might make some supplemental bets outside of that. Maybe they believe technology is going to do well, so they'll put some, maybe 5% of their portfolio towards a fund that tends to emphasize tech stocks, or they like international, or they like emerging markets. So that hybrid approach, I think, can also work as well. I'm not against that. I know plenty of people out there that do something like that. I'd say it's for the person who doesn't want complete autopilot, but doesn't want to be shouldering all the investment decisions and calculations completely themselves. Sort of using this 75-25 or something like that gives you a little bit of best of both worlds. All right. So I mentioned before that if you're using multiple different vintages, that you might distort the glide path. So what is the glide path? The glide path for a target date fund is basically how the money scrolls down from being more in stocks to being more in bonds or cash. So as you get older, as I mentioned before, the beauty of the target date is that it accounts for the risk. It makes a more aggressive portfolio more conservative automatically. So this is kind of what the glide path for T. Rowe Price looks like. It is that red line. The black line through the middle of the chart here is the average glide path. So the left-hand side of the chart is what percentage of the portfolio is in stocks. And then the x-axis, these would be younger people of the year 2055, so that's a long time into the future. So that would typically be younger people who would be using that out to people who are soon to retire or who have already retired. So a couple of conclusions to note, with T. Rowe Price and kind of how they approach things, they tend to have more money in stocks in the accumulation phase. So as you're getting out towards age 65, they tend to have more money in stocks than average. All right. The second thing to kind of keep in mind is even when you get out to retirement age, so I don't know if people can see me moving my cursor here, but in between the year 2020 and 2015, that's kind of where we are right now. This would be anybody who's going to be 65 right around now. You'll note T. Rowe Price tends to have more money in stocks even for an older person at age 65, and that continues out for roughly another 15 years. So T. Rowe is definitely emphasizing the stock side of the equation. Why are they doing that? They're doing that for a very specific reason. So there's kind of two different schools of thought with target date funds. There is what they call a through the date strategy and a to the date strategy. The to the date basically would say that when you get to age 65, you're going to take your foot completely off the accelerator, and the majority of the money will go into bonds and cash, and it will stay that way from age 65 until maybe age 90, something like that. So the thought would be, okay, we're going to protect the money right up until the point at which you'd be drawing the money out. The downside to the date strategy is what happens if you run out of money? What happens if you make the portfolio so conservative at age 65 that as you begin pulling money out, you run out of money at age 80 or something like that? So the through the date approach basically says, hey, we don't expect everybody to die at age 65. People could live easily another 20, 25, even 30 years in retirement. So we need to plan for that. So in order for the portfolio to continue to grow, perhaps at a rate above what people typically take out, we need to have more money in stocks to make the portfolio grow faster. So that is sort of the concept behind this through the date strategy, and that's effectively what T. Rowe Price subscribes to. They are a through the date manager. Okay. Hopefully everybody can still see my screen. Yeah, it looks like it is still sharing. Okay, that's good. So what I wanted to show you here was a little bit on return. So again, kind of like we were looking at before, T. Rowe has been very successful with their strategy. You can see whether that's year to date, 12, 3, 5. I even have 10-year results. The performance on the T. Rowe funds have been very strong. So quite frankly, on a 10-year basis, they're basically beating everybody else out there. So most of the funds are in the top first percentile in terms of return. But much of that, continues whether you're looking at a shorter trend or even a mid-year trend or midterm trend. So the performance has been very successful. They've done a very nice job with kind of how they've approached building the target dates. Second thing is they are actively managed. So when you look under the hood and you want to see what types of funds are being used, the majority of them are actively managed strategies, so not indexes. They do have some index in there, but most of them have been actively managed. So the other piece of it is when you look at, again, like I said, what's under the hood. We'll see it. Screen's going to move on. Here we go. These are the underlying funds. So these are the various different T. Rowe Price funds that are being used to build the target dates. So as you kind of peruse these, I think, again, you'll find many of the funds have performed particularly well, again, over long-term periods. I have the Morningstar ratings on the different funds as well as kind of a snapshot. So more than half of the funds that are being used are either 4 or 5 star from Morningstar. So a lot of that is kind of what's accounting for the strong results. What about fees? So active management, they're doing a lot of work. What do I have to pay to basically hire T. Rowe Price to make the investment decisions on my behalf? So I've got the expense ratios on each of the different funds here. Is T. Rowe the cheapest out there? Probably not. They're not overtly expensive, but they are not the cheapest on the street. And you can kind of see that with the prospectus net expense ratio rank. So almost all of them are below average in terms of cost, but they are not necessarily rock bottom. Where I think the next question would be is, okay, for what I am paying for a target date manager, is it paying off? Am I getting something for it? So I included this column. Again, I want to look over a long period because that's kind of how these funds are built. But if we look at how much additional return these funds generated relative to the average target date fund out there, you can see that in the very last column. Over the past 10 years, the T. Rowe Price 2005 fund has generated 75 basis points or 0.75% more return per year for 10 years in a row relative to the average target date that's out there. And then you got to see what those numbers look like as you scroll through the rest. So you've definitely gotten bang for the buck with the T. Rowe funds. They've generated plenty of additional performance over and above what the cost might be for managing these portfolios. Okay. So quick summary. Target dates, like I said, there's not a right or a wrong with this. This is more a personal preference. But for those that are looking for simplicity, for those that do not have a lot of time or are not this is not very interesting for them to keep an eye on this kind of stuff, the target dates can make a lot of sense. Usually people will pick a single vintage that aligns with their retirement date. I noted, I guess you could say a common investor mistake might be to blend different glide paths. I don't think that ultimately ends up with what you want. So for the person who has, a third of their money in the 2030 fund, a third in the 2040 fund, and a third in the 2050 fund, maybe there's a different way of doing that that might yield a better result. We looked at the glide path. So I pointed out how T. Rowe is a through the date manager, so they tend to favor equities not only as you approach retirement age, but even after retirement age. But that equity component there has paid off for them. The performance on the funds has been particularly strong. I would draw people's attention as well to again, just 3 months, but the first 3 months of this year, the first quarter returns on the target dates again continue to be strong. So even one would almost anticipate if the market got rocky or if the market went down, we'd see more of a decline with the T. Rowe funds. They held up very well for first quarter. Costs of the funds are below average. They are not the cheapest on the street, but for the return that you've generated from those funds, it's been a very good payoff. So that's my quick summary on the target dates. Let's see. All right, I'm at 2:54 Eastern time, so I think I will turn it over to Carly here to maybe read off some questions. I'll do my best to try and answer.
All right, thanks, Kendall. So we have two similar questions on the same topic about the target date funds. Mm-hmm. So do target date funds regularly outperform index funds?
Okay. Do target date funds regularly outperform index-based target dates? That would be a more probably accurate comparison. If you look at T. Rowe Price relative to, say, Vanguard's target dates, T. Rowe has done better than Vanguard. T. Rowe has better returns than Vanguard, even net of fees. Should I say, if I said in general target dates, have they done better than the index-based strategies? I don't think so, but for T. Rowe Price, the situation is different. They have outperformed the indexes.
Okay, and that's based off of performance, but then we also have a question on how does the additional cost of the actively managed T. Rowe target date funds look when compared to the index funds?
Okay, so the performance is all net of fees. So T. Rowe has actually beaten Vanguard even with the fees included.
All right. Okay. So here is, given the recent tax law changes, could you talk about investing in a traditional pre-tax 401k versus a Roth 401k?
Okay. So yeah, that could be a long discussion, but I think people would have to look at their own sort of tax situation to see if they move to a different bracket, if they went to a lower bracket. So if their bracket went down, then it could be interesting to relook at the pre-tax versus the Roth decision. However, even if you move to a slightly lower bracket, but you're 30 years old, and then in our opinion, Roth still is going to be kind of the way to go. If you've got a long time before you're going to use the money, you're still going to build up. You're going to build up a lot of gains in your account. If you have 20, 30, 40 years before you're going to use the money, then I would bet on the gains there, and you don't have to pay any income tax on the gains. So, in some ways, if the more I think about it, the more the brackets go down, you're paying less to pay the taxes today. So in some ways, maybe that actually favors Roth. It's less expensive to contribute on a Roth basis. That'll be my 2 cents on that.
Okay, thank you. And then we have a question about, you know, how do I judge the fees/costs of holding my money in a 401k versus an IRA? And also worded as somebody can see the fund's expense ratio. Is this the total expense in their 401k, or are there additional fees and costs?
Okay, so with the Dassault plan, the only expense is the expense of the funds. So the expense ratios of the funds, that's it. So what is disclosed, what's shown on Fidelity site, etc. That's all of it. I just would counsel people just recognize, and I don't think it'll show up so much here, but there is a gross expense ratio and a net expense ratio. You would want to look at the net expense ratio. The gross is the most the fund company could possibly charge for running a specific fund. So it's not what they're actually charging, it's just the most they possibly could. Many fund companies will kind of bake it into their prospectus and into sort of the charter of the fund that they have some range, I guess you could say, in terms of what they're going to charge for services, but doesn't necessarily mean that they're going to come out of the gate charging the most they possibly can. So as you look at maybe the fact sheets on the fund, you want to look at that net expense number. I would also kind of draw people's attention to, if people want to look at keeping fees down, we do have a full complement of index strategies as part of the plan. We have a large cap index, a mid cap index, a small cap index, fixed income index, an international index. So if you wanted to build a portfolio that was pure index and have an average expense of maybe 7 basis points all in, you can certainly do that. If you want to supplement perhaps some of the index options, you can do that as well. We have some actively managed funds as well that you can build into the mix. So, I think part of what we've tried to do as we assemble the different offerings as part of the plan is give people flexibility. Those that want, I want to just match the return of the market and keep my costs as low as possible, you can do that. I want to try and beat the market and I'll pay up a little bit for that, you can do that too, or some combination thereof.
Okay. And Kendall, there are a few other questions we have. So I think at this point in time, since we've hit 3 o'clock with those employees' questions, I'll provide those to you and then I'll get back to the employee with the answer. Does that work?
Sure. That sounds great.
Okay. All right. Well, thank you everyone for attending today, and thank you for Kendall's time in presenting this information. As always, the benefits team here is if you have any questions, and you can reach out to America's HR if you do, and we can provide that to Kendall. So please let us know. Again, Kendall is located in the Boston area, and he does have services for retirement planning if you have any questions. So all that information can be found at rewards@3ds.com. And I think that wraps it up. So thank you, Kendall.
Yeah, I put some of the contact information up on the screen as well, so hopefully people can see that. Whether you want to reach out to Fidelity, whether that's via web or their 800 number, or if people would like to talk to myself or my coworker Adam, that's our contact information there. I guess the only just one thing to be aware of: there is an underscore between the Kendall and the Storch, which is you probably can't see. But it does exist. So it's Kendall_Storch@hag.com.
Perfect. Okay. Thank you, Kendall.
Thanks, Carly. Appreciate it.
Thank you. Take care. Bye-bye.